Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So now I'm going to start unit number 3 in financial institutions and markets. The last unit number 2 I have completed 10 videos that covers the complete topic of financial institutions. Now the topic of this unit number 3 is money market. So in this video I'm going to explain you about the meaning of the term money market and what are the features of money market. So in examination you will get the question regarding the explanation of money market and the features. So watch the video till the end to get the complete command on this subject. So if you are interested in getting a full command on this topic of financial institutions and markets, watch all the videos from beginning till end. So go to the playlist of my channel, select the subject financial institutions and markets. Watch all the videos, be acquainted, be clear with the concepts so that confidently you can write in examination. So before starting the explanation of money market, take the screenshot of the points which I have written on the board. Then I'll explain about what is money market and what are the features of money market. Now, see, there are two types of markets called capital market and money market. The capital market is a long-term market where the funds are borrowed and lended for a long period of time. So, second type of market is the money market, which is a short-term market where the securities are bought and sold for a short period of time. So actually the business organization require funds for two purposes. First of all, the business requires funds for making investment in capital assets, like purchasing a machine, purchasing a building, purchasing equipment. For all these purposes, long-term funds are required. So they have to approach the capital market. From capital market, an organization can procure the funds for long-term purpose. Similarly, a business organization requires funds for working capital, day-to-day expenditure. So short-term funds are also needed by a business. That there should be a market, we should supply short-term funds. So some people are there who want to make the investment for a short period of time. So they are the investors for short period and there are the borrowers for short period. So a market where short-term investor and short-term borrower will meet each other, that market is called money market. So according to SEBI, Securities and Exchange Board of India, money market is a market for debt securities that pay off in the short term, usually less than 1 year. So what do you mean by short period? The period of less than 1 year is treated as short period. So in the money market, all debt instruments will be debt, not equity. Only debt instruments will be borrowed and lended during this period of less than 1 year. So according to SEBI, money market is a market where debt instruments are traded for a short period of time, that is less than 1 year. This market encompasses the trading of a short-term non-equity debt instruments including treasury bills, commercial paper, bankers acceptance, certificate of deposits, etc. These are the instruments which are dealt, which are traded in the money market. Now, money market is a market for securities that are issued for a short period of time, and short period is understood to be for a period of less than 1 year. So all the short-term securities are traded in the money market for a time period of less than 1 year. So money market constitutes an important part of the financial system in any country. The money market occupies a very important part because it plays a role of mobilizing the money, collecting the money who are savers and who want to invest for a short period of time. And this money will be diverted to the organization which require fund for a short period of time. So there is a need of short-term funds and there is a supply of short-term funds. So money market is a situation in which the borrower and the lender of short-term funds will come in contact with each other. Now, money market includes primary market, new issue of new securities, and secondary market, trading on existing security, but restrict themselves for short-term people. This money market will trade both securities, the primary market security and secondary market security. The primary market security is the new issue market. The first time the company is issuing the security to raise short-term funds. Similarly, secondary market, the trading will be done for existing securities. Existing securities are bought and sold in the secondary market. So both primary market and secondary market are dealt with money market. Now, money market helps organization meet their working capital requirement. Working capital means the amount required for day-to-day expenses. That is called working capital. Current assets minus current liabilities. So for meeting working capital requirement, the business organization will come in contact with money market. From surplus money held by individuals as well as institutions for a short period of time. So there are individuals, there are institutions which have surplus money, which idle money will not generate any income. The idle money will incur cost. So why to keep idle money even for a short period? That means the individuals, the institutions will try to invest that money even for a short period of time, right? So they will get the return. They will get the return. The investors will get the return on investment and the borrower can be able to meet their liquidity position. They solve the problem of liquidity management faced by almost all organizations. Almost every organization will face the problem of liquidity. Liquidity means ability of the business to pay the current obligations on time. So day-to-day expenditure like monthly salaries will be paid, rent will be paid, electricity bill will be paid. So many expenditure, recurring expenditure will arise. So a business must be able to meet all these obligations on time. Then we can say liquidity position is good. But every business, the liquidity position is not good. Some business houses will find it difficult to pay the current obligations on time. So they have to take the help from money market. They have to borrow the money from money market for short-term purpose. It also provides a means to generate returns from short-term surplus money. So this money market is not only helpful to the borrowers, the money market is also helpful to the lenders. There are many people who are having surplus money for a short period of time. So why to keep idle money for a short period of time? Instead of that, we can be able to invest it. Example, in a particular bank, XYZ bank, normally it will have cash in hand of rupees 5 lakh. Always they will keep 5 lakh rupees cash in hand. But on a particular day, continuously 2-3 days, there is excess money on hand. Instead of 5 lakh, 6 lakh, 7 lakh rupees are there. So the bank will decide that why to keep this excess 2 lakh rupees in hand, we will invest it for short-term period so that they can be able to get a small return. So one extreme is there. Keeping a rupee idle for a day will incur cost, will not give any return. So don't keep idle funds even for a short period of time. Invest it so that we can be able to get the return. So this money market will be helpful for both the parties, for the investors and also for the borrowers. Now, hence money market are an essential part of economic development in any country. The money market plays a very important role in the economic development because it will channelize the idle funds from the savers to the users. Now, banks are the largest participant in money market as they borrow and lend from each other for a period as short as 1 day, called money market. The biggest participant in this money market are banks because banks deal in money. Every day they will get a lot of money, inflow of money, outflow of money. Every day so much of money is there in the bank. Now the bank has to effectively utilize the money. That means money should not be idle. So whenever there is surplus money, even for a day, they will not keep it idle. The bank will lend it to another bank. Suppose another bank is there who is in shortage of funds, temporary basis on one day. For a particular day, there is shortage of funds in bank XYZ, whereas there is surplus money in ABC Bank. So ABC Bank will lend the money to XYZ Bank only for a day. It is called call money. It is called call money. That means the money lended and borrowed for a short period, even for a day. So the biggest participant in this money market are the banks. They will borrow a short period of time. Now, large financial institutions and corporates also participate in the markets. Not only banks, but also financial institutions are there, corporates are there. They also participate in the market. Individuals can participate in this market through money market mutual fund. See here, not only the banks, financial institutions or corporates, but also individual people can also enter into this money market. Not directly, but through mutual fund. In mutual fund, there is a scheme, money market scheme. So individual can be able to invest in that mutual fund scheme to get the returns. Now, treasury bills, then commercial paper, repos and term deposits are the typical instruments that are traded in money market. In the next video, I am going to explain you about the instruments which are dealt in money market. The important instruments are treasury bills, commercial paper, certificate of deposit, repos, etc. Now, these instruments enjoy high liquidity and are issued by large reputed organizations for a short period of time. Hence, the risk associated with money market instruments is relatively much lower. See, in this money market, the instruments will carry low risk because money is borrowed and lended for a short period of time. So during the short period of time, the risk exposure will not be high. So in this short money market instruments, the risk attached is very low. Now, features of money market. So far, I have explained you about the meaning of the term money market. Now, what are the features of money market? The first feature is short term. In the definition itself, we have discussed money market is a market where short term funds are lended and borrowed. That means investment is made for short period and borrowing are also made for short period of time. That is the first feature. Period means less than 1 year. Short period means less than 1 year. Secondly, many sub-markets. In this money market, we have so many divisions called sub-markets. And every sub-market will deal with a particular type of instruments. Example, call money market. In call money market, the money is borrowed and lended for a very short period like 1 day. Only for 1 day, the money is borrowed and lended. That is a call money. Bill money market, the market where bills of exchange are traded for a short period of time. Like this, we have subdivision in the money market. Thirdly, high liquidity. Liquidity means convertibility. Easily we can convert the instrument into cash and cash into instrument. High liquidity is there for the instruments which are dealt in money market. So money market is characterized by high liquidity. In fact, it is market to balance the liquidity needs of various participants. So ultimately, it depends on the requirement and availability of short-term funds. Next one is large denomination. Normally, the money will be borrowed and lended not in small amounts, but in large amounts. The money borrowed and lended in short-term market will be large denominations. They will not borrow in thousands. They will borrow and lend in lakhs or crores. So the denomination is large. So transactions in money market are typically in large denomination. For example, when one bank borrows from another bank for a short period, like 1 day, it will not borrow in thousands. It will borrow in lakhs and crores. Next feature is low risk. Just now I told you, the risk attached with the money market instrument is the lowest because the duration of time is very less. In such short duration of time, it is difficult to change the perspective of the organizations. There won't be any much change in the organizations during very short period of time. When there is no risk, definitely the return will also be low. So money market typically involve large reputed organizations. The borrowing are for a very short period of time. Thus the risk of default is very low. For example, when SBI borrows rupees 1 crore from HDFC for one day, the management of HDFC will not worry too much as to whether SBI will collapse in one day. Example I have given. Suppose this SBI needs to borrow 1 crore for one day and they approach HDFC. HDFC has given the loan for one day. So HDFC will not think much about the SBI, about the borrower, because in one day itself the SBI will not collapse. Any organization all of a sudden will not collapse. It will take much time. So the risk is low in case of money market instruments. Large players. One more feature of this money market is there are a number of players will participate in the money market. Banks, financial institutions, corporates, individuals, mutual funds. So many participants are there in the money market. So large players. Then OTC. OTC stands for over the counter. Over the counter means any transaction which takes place, any contract taking place between two parties. No third party is involved. So for entering into money market transaction, two participants, two players face to face each other and enter into contract. There is no such place that just like stock exchange. Stock exchange or future exchange is a place at which the contracts are entered. But OTC means the contract can be entered at any place face to face by the parties. So here money market transactions will be conducted face to face. No third party is involved. Next is no periodic cash flows. When the money is borrowed and lended in money market, only one cash flow, one cash inflow, one cash outflow will be there. There is no intermediate flow of cash, just like interest. Just like interest. Interest will not, pass from one person to another person. Only one cash inflow, one cash outflow. No intermediate cash flows. So now, wide fluctuation in interest rate. Money market can witness huge fluctuation based on liquidity in the market at any point of time. So the rate of interest in money market will fluctuate depending on the requirement, depending upon the liquidity in the market. If the liquidity is more, high liquidity, so more instruments are dealt, the interest rate will fall down. Similarly, if there is no liquidity, that means there is a shortage, there is money shortage in the market, then what will happen? The interest rate will high. So lot of changes will take place in the interest rate in the money market. The last one is barometer of monetary policy. Participants of money market reflects how the participant react to the monetary policy of the central bank. The monetary policy, when it is framed by the government, central bank, then what will happen? What is the reaction? What is the reaction on the participants of the money market? It will be reflected. The monetary policy is reflected in the money market by seeing the changes in the participants. Now, if the markets think that monetary policy will ease liquidity, then interest rate will fall. See here, if the market assumes that the new monetary policy will ease the liquidity, which increase the liquidity, then what will happen? The interest rate will fall. The interest rate will fall. Then what will happen? Various instruments. Here, if the market think that the monetary policy will ease, then interest rate will fall. Various instruments will trade at higher prices. Because interest rate is falling, so various instruments are traded at a higher prices. This will happen when the monetary policy eases the liquidity position. Then what will happen if it is opposite? If the monetary policy tightens the liquidity, then what will happen here? If the market thinks that the monetary policy will tighten liquidity, then interest rate will rise. The interest rate will rise. Then what will happen? Various instruments will trade at lower prices. So when the interest rate increases, the instruments will be traded at a lower prices if the monetary policy tightens the liquidity. So this is the barometer of monetary policy. So in this video, I have explained you about the meaning of the term money market and what are the features of money market. Inshallah, in the next video, I will explain about the functions of money market.